Hey everyone, welcome back to Corporate Decoder, the place where we untangle the numbers so you don't have to get ready because Medifast's latest earnings report is kind of a wild ride, a mix of struggles and some surprising resilience. Before we dive in, if you like getting straight talk on company financials, smash that subscribe button. And for more insights, join our Discord community linked in the description below. Alright, so this report from Medifast covers their financial performance up to June 30, 2025. And let's just say times have been tough for them lately. We're looking at the revenues, and for the 3 months ending June 30, they brought in about $105.6 million. That's a pretty big drop from the $168.66 million they made during the same time last year, a nearly 37% decrease. That's like losing $1 in every $3 they used to make. Now, look at their selling general and administrative expenses, which we can call SG&A. That's a huge chunk, costing them $77.7 million in this quarter. Even though their revenue dropped significantly, their SG&A costs also went down, but not as much. This means they're spending a lot of money to try and make sales. And what happens when expenses are high and sales are low? You get an operating loss, and that's exactly what happened. Medifast reported an operating loss of about $1.1 million for this quarter. That's still a loss, but it's much better than the almost $8 million loss they had last year. So they're losing less money, but they're still losing money from their core business. But wait, there's a twist now. Look at the net income, which is the bottom line. The company reported a net income of $2.5 million. This is a huge turnaround from the $8.2 million loss last year. That sounds good, right? But how did that happen when their main business operations are still losing money? Well, it turns out a big reason for this profit was something called other income and expense, which was over $4 million in profit this quarter. This mainly came from selling off their investment in a company called LifeMD. That sounds like they're closing a chapter and maybe cutting some losses. They also mentioned their stock numbers for earnings per share calculation. The figures here show around 11 million shares outstanding, which is pretty standard. Looking at their share-based compensation, you can see they've been using stock awards to pay their executives and key employees. The numbers here show how many shares are tied to performance and when they're expected to be recognized as expenses. Let's circle back to the cost of sales, which is the direct cost of making their products. That's down to $28.9 million from $45.1 million last year. This makes sense because they're selling less product. Less sales means less cost to make the product, but the gross profit margin, which is how much they make after those direct costs, only slightly decreased. Digging deeper into their segment reporting for their Optavia business, the company describes their sales, marketing, and after-sales support costs, which were a massive $50.5 million for just this 3-month period. That's a big chunk of their revenue. Now, this tax line is interesting. They paid about $4,000 in taxes this quarter, but last year they got a tax benefit of nearly $2.5 million when they had a bigger loss. This often happens when companies have losses they can carry forward. A shift from a tax benefit to a tax expense suggests profitability is returning, although driven by non-operational factors. Looking at the 6-month period ending June 30, the story is similar. Revenue dropped significantly from $343.3 million in 2024 down to $21.43 million in 2025. That's a 35.5% drop. This continued decline in revenue is a major concern, and it seems to stem from a shrinking number of active coaches. Their SG&A expenses for the first half of the year were $63.2 million. This is also down from last year, but again, not keeping pace with the revenue drop. They've been trying to cut costs by optimizing their supply chain and canceling a convention, which helped, but the underlying problem of fewer customers is still there. For the first 6 months, they actually posted a net income of $1.7 million. That's a huge improvement from the mere $1,600 they made last year. Again, much of this is due to that other income, mostly from selling that LifeMD investment. Now let's talk about cash. They have about $121 million in cash and cash equivalents, which is up from $90.9 million at the end of last year. This is good. They have cash on hand, which is crucial for survival, especially when sales are down. Their inventories are down to $30.2 million from $42.4 million. This suggests they are selling through their products faster or planning for lower sales volumes. That makes sense given the revenue trend. On the liability side, accounts payable and accrued expenses are down to $40.3 million from $56.5 million. This could mean they are paying off their bills more aggressively, or that their business activity has slowed, impacting their short-term obligations. They also disclosed information about restricted stock, which is part of executive compensation. You can see grants and vesting schedules impacting their equity. They have investments, and these are categorized by how easy it is to determine their value level 1 investments. Like money market funds are based on readily available market prices. Level 2 investments like corporate bonds require more complex calculations but still rely on observable market data. Their corporate bonds are valued at $40.8 million. They mentioned their collaboration with LifeMD. They sold their investment in LifeMD during this quarter, but the collaboration continues. This shows they are trying to adapt to new trends like medical weight loss solutions, even if their core business is struggling. Their entire business now seems to be focused on the Optavia segment. This is their direct selling model where coaches help clients. Back to the Optavia segment, revenue for the second quarter dropped to $105.6 million. This is the core of their business and it's shrinking. And within Optavia, their selling, marketing and after sales support costs are just enormous $50.5 million, a huge expense compared to their revenue. And within that segment, their net income is $2.5 million, which again is largely due to selling off that investment. The management discussion confirms the revenue drop due to fewer active coaches and lower sales per coach. They attribute this partly to the rise of GLP-1 weight loss medications, which are a significant competitive threat. That's a major factor impacting their business model. They also talk about SG&A costs and how they've been trying to control them by cutting convention costs and other expenses. But even with cost cuts, they are showing an operating loss, reflecting the difficulty retaining customers and coaches. The operating loss of $1.1 million is a key takeaway here. It means the core business isn't profitable right now, even though the overall net income looks positive. Thanks to that investment sale, their cash flow from operations is almost zero. This is concerning. It means the day-to-day business isn't generating much cash to keep itself going. They had positive cash flow from investing activities, which was mainly due to selling those investments, so they are selling assets to stay afloat. Financing activities show they aren't borrowing much and are even reducing dividends paid to shareholders, likely to conserve cash. What's the story here? MEDIFAST core business, Optavia is really struggling. Sales are down significantly and they're still losing money on operations even after some cost cutting. The rise of GLP-1 medications is clearly a major disruptor for their coach-led model. They're essentially trying to pivot or at least adapt to this new market reality. The good news is they have a decent amount of cash on hand and they've managed to become profitable on paper by selling off an investment, but that's not a sustainable strategy for long-term health. They need to fix their core business problem of attracting and retaining clients and coaches. Their SG&A costs are still very high relative to their current revenue, suggesting they might need more aggressive cost management, or they need to find a way to significantly boost revenue. The fact that they've reduced their active coaches by nearly a third in just a year shows a serious challenge in their recruitment and retention strategies. Looking at this overall, MEDIFAST is in a tough spot. They are facing existential threats to their business model from new weight loss technologies, and they haven't yet proven that adaptation strategy is working. Their reliance on selling assets for a profit is a red flag. However, they do have some financial cushion, which gives them time to try and turn things around. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time in Tania.